Welcome, ladies and gentlemen, to our first educational podcast. I'm your host, Konstantin Kai Alkandros, and I am going to be doing the Alkandros Capital Management Educational Podcast. Today, we're going to do a bit of a quick overview of the stock market, what it is, who's involved in it, the players involved in it, and sort of how things kind of work. I'm not going to go into too much detail. I want to keep it simple because the stock market is quite a large subject, and there's a lot of depth to it, more than you think. But for the average person, average investor, who's not an institutional investor and doesn't have the capital, doesn't have the kind of high volume of capital to invest or trade with, it's not really. You wouldn't really need to know that much, know too much depth about the stock market. Without using a dictionary definition of the stock market, I will just say that the stock market is a place called an exchange. It's called an exchange because exchanges happen there, financial exchanges happen there. And it's a place where people, and those people are buyers, sellers, and brokers, make trades or make exchanges of stock or shares of companies. That's fundamentally what the stock market is. So it's a place where shares or stocks are bought and sold. So that's what a stock market or stock exchange is. Well, the exchange is where the actual transactions occur. They're done electronically, so you don't have people actually literally people with money, bags of money or wallets of money going there and actually buying shares. So it's all done electronically. Now, mind you, it was done that way back 100, 200, 300 years ago. People would literally go there and exchange money for shares and stocks. You would actually have to go there a couple of hundred years ago and do that. Nowadays, it doesn't work like that. It's all electronic. So the only people on the trade floor are brokers who are doing the exchange, who are facilitating exchanges to happen. So that's what a stock exchange is. The stock market, I guess, is more or less just the environment where the exchange is involved. The market is kind of the greater body of buyers and sellers and entities that are involved with financial trading and stocks and shares. So, so I've told you what a stock exchange is. So the players involved, you've got a buyer, a seller, and a broker. Buyer is someone who wants to exchange their money for companies, for a share in a company or shares in a company or stock. Depending on which country you live in or where you're from, in America, they'll call it stock. In Australia, they'll call it shares. Mind you, those both terms are probably used in both countries, but it's more of a tendency. So in America, they'll describe it as, they'll call it stock. In Australia, shares. And probably New Zealand as well. Canada, probably more stock than shares. Anyway, that's just more, sort of looking at the linguistics of the terms. So your buyer exchanges, as we said, your buyer exchanges money for shares or stock in a company. Your seller is looking to sell their shares in a company or stock in a company for money. And a broker is the party in between the buyer and the seller who facilitates the exchange, and they get a commission from the transaction. So anytime a stock is bought and sold or share is bought and sold, the broker will get a commission on that for facilitating that transaction. So it's a very nice business to get into. If you become a stockbroker, you can make a lot of money out of it because there's a lot of trades happening. Probably much better to be a stockbroker than a stock trader. So if you can become a stockbroker, you've got a very nice future set out for you. Because basically, win or lose, you make money. Whereas stock trader has to win. They've got no options. They can't afford to lose. So it's very nice being a broker. Being a middleman is a nice position to be in. So all that trading happens on the stock exchange. So those are the players. A person, I guess we could maybe look at the motivations of the buyer and the seller. A buyer is looking to buy shares or stock in a company because they believe the value of that stock or share will increase in either the short, medium, or long term, and that will help increase their either their short, medium term profit, or it will give them help increase their wealth later down the line, or they'll think that that the stock or shares they're buying is in a company that will provide a lot of income in the form of dividends, not necessarily in the value of the individual shares themselves. The reason a seller would sell out, they're motivated to sell their stock because either they are looking to exchange the value of their shares for money. So they're looking to basically sell. If say if your stocks have gone up 10%, you'd be motivated. If you're motivated to sell at that point, your motivation is to make money. So you want to sell the increase in value and get money back for that. You might also sell for negative reasons, either because you feel a stock's going to continue to drop. Maybe you're in a losing position and you don't want to lose more money, so you sell to limit your losses. That's kind of the motivation of a seller. Broker, there's no motive. They're only motivated by making money through the facilitation of an exchange. Now, I mean, really, it's as simple as that. That's what a stock exchange is, and the stock market is. That's really all it is. It's really just an exchange. There's other aspects to that. This is something I think I'll probably cover in either in subsequent podcasts or maybe later podcasts. I'll look into the stock market in more depth, but that's really fundamentally what it is. You have stock exchanges all across the world. Many countries have their own stock exchange. For example, in Australia, you have the Australian Stock Exchange. It's known as the ASX in short, which stands for the Australian Stock Exchange. It's based in Sydney. New Zealand has their own called the NZX, New Zealand Stock Exchange, based in Auckland. The US, of course, has its own. Canada, UK, Russia, Mexico, even, you name it. Lots of countries have their own stock exchanges. Japan, you get the idea. So trading happens in all those places, and as I said, it happens remote. It happens online. Trades are done through online platforms, trading platforms, or through banks. They're not done in person. So many stock exchanges, millions of trades, if not, probably more like billions of trades per day happen on the stock exchange. Lots of companies are listed on these stock exchanges, more so in other countries than in others. So for example, in Australia you have 300 companies, in New Zealand you have only 50, and in I'm trying to think of one country in particular. I think it's the Saudi Arabian Stock Exchange. I think there's only like a dozen countries. So some exchanges have more companies than others. All the companies listed are publicly listed companies, so they're not private entities. A private company wouldn't be listed on the stock exchange. It does cost money to be listed on the stock exchange. I think recently I looked at the cost of becoming a publicly traded and publicly listed company on the Australian Stock Exchange. You're looking at, I believe the fee was $50,000. So it costs a lot of money. And I think you have to have 200 non-related, non-affiliated investors in your company. So there's some very there's some obstacles to becoming a publicly listed company, but you have to be one to be on the stock exchange, basically, and to have your trades bought and sold. There's reporting as well. publicly listed companies have to do reporting, so they got to report to investors, and their news, their reports and any news regarding those companies, of course, becomes public knowledge. It gets put out there in the public domain. So obviously, the news reports will cover the news that happens in these publicly listed companies. A private company won't. Of course, a private company could still have their company in the news, but it won't be in regards to the stock market. So there's lots of different types of companies in the stock market. So there's different sectors. You'll have things like resources and mining. You'll have technology, or tech for short. So technology sector, resources mining sector. You'll have like confectionery and food. You'll have another sector for defense. You'll have another sector for agriculture and utilities. There'll be a sector for that. Every stock exchange has a sort of a bit of another sector for banking and financial services. So there's different sectors, and different exchanges have a different way of dividing each sector up. They'll use different terms, and there'll be different, different requirements for, a utility sector may be made up of different types of companies in the U.S. than it is in New Zealand, say, for example. So I think it's probably a good overview. I think we'll leave it at that for now. I think that pretty much covers sort of the basics about the stock market and stock exchange. Probably we'll go into it a bit more in depth in a subsequent or in a future podcast or two. I may change the subject in the next podcast, but if I don't, then you'll learn more about the stock exchange then. Otherwise, we'll leave it at that. This is Konstantin Kayal-Kandras signing out. Thanks for listening.